Gold at $2,200, silver at $81, and something is breaking. Not on Wall Street, not in the headlines, but in the shops, in the households, in the quiet decisions being made by people who never speculated a day in their lives. They're walking away from gold, not because they lost faith, but because they can't reach it anymore. And what they're reaching for instead is creating a pressure point most analysts won't see coming. By the end of this briefing, you'll understand why this shift isn't temporary, why it's structural, and why the next 60 days might be the last window before the crowd realizes what's already happening. Welcome to John Analyst. If you've been following markets long enough to remember when information wasn't free, when research required effort, and when analysis meant something more than a 5-second prediction, then you're in the right place. This channel doesn't insult your intelligence. We don't hype. We don't entertain. We brief. And if that approach resonates with the way you prefer to process serious information, then I'd appreciate it if you'd subscribe. Not for the algorithm, for the signal. Because the people who find value in this kind of work tend to be the people worth building a community around. Also, I'm curious, where are you watching this from right now? Are you in the States, Europe, Asia, the Gulf? Drop your location in the comments. Not because I'm taking a survey, but because I want to know how far this analysis is traveling and whether what I'm seeing in one region matches what you're witnessing in yours. Now, let's get into the substance. On Tuesday, February 10th, 2026, gold closed near $2,257 per ounce. Silver closed near $81. Most people scrolled past those numbers without a second thought. But a small group of analysts, the kind who don't chase headlines, stopped. Because when they divided those two figures, they landed on a ratio that hasn't been this stretched in years. 64 ounces of silver to buy 1 ounce of gold. And that number, quiet as it seems, is where the story begins. In nature, silver and gold occur at roughly a 15-to-1 ratio. 15 ounces of silver in the ground for every ounce of gold. But in the market, that ratio moves. Sometimes it sits at 30, sometimes 50, sometimes, like now, it pushes past 60. And when it stretches that far, something psychological happens. People start asking a dangerous question. Is silver the cheap seat on the same ride? It's not about charts. It's not about technicals. It's about what ordinary buyers feel when they look at the price. Gold at $2,200 feels heavy, not physically, psychologically. It feels like a commitment, a serious decision, the kind of purchase that requires a conversation with a spouse, a review of the budget, a moment of hesitation. Silver at $81 feels reachable. It feels like something a person can do today without restructuring their entire financial life. And that difference, that simple emotional calculation, is what drives behavior. There's a pattern emerging that doesn't show up in official reports. Dealers in multiple regions have started noticing the same shift. More people walking in, asking for silver, fewer people walking in, trying to sell it. That's not speculation. That's inventory flow. When demand is soft, shops compete for buyers. They offer discounts. They negotiate. They make deals. When demand is firm, shops compete for metal. They raise premiums. They limit quantity. They manage availability. And lately, the language has changed. Phrases like limited stock, next shipment uncertain, call before you visit, have started appearing. Not everywhere, not yet, but in enough places that the pattern is no longer anecdotal, it's measurable. Here's what nobody wants to say out loud. Gold has priced itself out of reach for a significant portion of the market, not for institutions, not for central banks, not for the wealthy, but for the average saver, the small business owner, the household trying to set aside something tangible. Gold has become a luxury they can admire, but not acquire. And when that happens, people don't stop wanting hard assets. They adapt. They look for the next closest thing, something that still feels real, still feels solid, still feels like it holds value outside the banking system. That's where silver enters the frame, not as a replacement for gold, as a practical alternative. Analysts who track retail behavior, not institutional flows, have started identifying 3 signals. Signal 1, the questions people ask. A year ago, the question was, what's the gold rate today? Now, the question is shifting to how much silver can I get for the same money? That's not a small change, that's a reframe. Signal 2, the way sellers behave. When a dealer starts checking inventory multiple times a day, when they start calling suppliers to confirm delivery dates, when they start turning away bulk orders because they're not sure they can fulfill them, that's stress. And stress in the physical market always precedes movement in the paper market. Signal 3, premium expansion. The difference between spot price and real-world purchase price is widening. In some regions, buyers are paying 5, 10, even 15% above spot just to secure physical metal. That spread That gap between the screen price and the counter price is the most honest indicator of real demand. When premiums rise, it means people want metal more than they want dollars. This rotation from gold to silver isn't driven by hype. It's not driven by a viral post or celebrity endorsement. It's driven by something far more durable, affordability. And affordability, once it becomes the dominant factor in a market, doesn't reverse easily. Because the people making these decisions aren't speculators. They're savers, families, small business owners, people who move slowly but consistently. And when millions of those people across multiple countries start making the same quiet decision, the market doesn't get loud right away, but it gets tight. And tightness is what comes before the headlines. There's a country most analysts ignore when they talk about precious metals, Pakistan, not because it's irrelevant, but because it doesn't fit the narrative. It's not a major player. It's not a central bank headline. It's not moving billions. But that's exactly why it matters. Because Pakistan, in 2024, imported roughly $27.4 million worth of gold, ranking it 84th globally. Not first, not 10th, 84th. And that number, small as it seems, tells a story most people miss. It tells the story of constraint, when cultural tradition meets economic reality. In Pakistan, gold isn't just an investment. It's woven into the fabric of life. Weddings, dowries, family savings, security. For generations, gold jewelry was the way a household stored value, the way parents protected their children's future, the way wealth moved between generations without touching a bank. But something has shifted, not overnight, not dramatically, slowly, like water changing course. Because when gold climbs past a certain threshold, when the weight a family used to buy becomes unaffordable, they don't abandon the instinct. They adapt it. The substitution pattern. Here's what's happening on the ground. A bride still wears jewelry at her wedding, but instead of 22-karat gold, it's high-quality imitation. Beautiful, traditional, indistinguishable to most guests. The money that would have gone into that gold goes somewhere else. Silver bars, silver coins, smaller pieces of actual metal. Not for the ceremony, for the savings. This isn't replacement, it's rebalancing. The tradition stays visible. The security stays tangible. And silver, affordable, accessible, still precious, becomes the bridge. Why this pattern matters globally? Pakistan isn't unique. It's representative. Across South Asia, across the Middle East, across parts of Latin America and Africa, there are millions of households making the same calculation. Gold used to be within reach. Now it's not. But the need for something real, something outside the currency system, hasn't disappeared, so they shift. Not to stocks, not to crypto, not to paper promises, to the metal they can still hold. And when you multiply that decision across millions of families, across dozens of countries, you don't get a headline. You get a slow, grinding pressure on supply. The dealer's dilemma. There's a man in Karachi who runs a small jewelry shop. He's been in the business for 30 years. 6 months ago, most of his customers asked about gold. Now, more than half ask about silver, not because they don't want gold anymore, but because they've done the math. With the same budget they used to allocate for a single gold bangle, they can now buy several silver pieces. And psychologically, that shift matters. Because buying one piece feels like a transaction. Buying several pieces feels like accumulation. It feels like progress. And progress, even small progress, keeps people engaged. The premium problem. Here's where the story gets technical, but important. When someone looks up silver price on their phone, they see spot price. $81, $83, $79. But when they walk into a shop, the price is different. Sometimes 5% higher, sometimes 10, sometimes more. That difference, that gap between screen and counter, is called the premium. And the premium tells you everything. When premiums are low, it means supply is comfortable. Dealers aren't worried. When premiums rise, it means metal is getting harder to source. Dealers are protecting themselves. And lately, in multiple regions, premiums have been climbing, not because dealers are greedy, because they're uncertain. Uncertain when the next shipment arrives. Uncertain if they can restock at current prices. Uncertain if demand will stay this consistent. Uncertainty, in the metals business, always costs money. And that cost gets passed to the buyer. The inventory tightness, nobody sees. Large institutions don't care about premiums. They buy in bulk, they negotiate, they move size. But retail buyers, the family in Lahore, the small business owner in Manila, the young professional in Nairobi, they feel every percentage point. And when inventory tightens at the retail level, when shipments slow, when availability becomes a question instead of a guarantee, that's when the whispers start. Better buy now. Might not be available next month. Prices could go higher. Whispers in tight markets become self-fulfilling. What the data doesn't capture official import numbers lag. They report what happened months ago. But behavior, real-time behavior, is happening now. And the behavior says this: people who used to save in gold are shifting to silver. Not all of them, not everywhere, but enough. Enough that the flow is visible, enough that dealers notice, enough that premiums react. And here's the critical part. Once this pattern establishes, once households adjust their saving strategy, once cultural norms adapt to new price realities, it doesn't reverse quickly, because these aren't traders. These aren't speculators. These are people building security, one small purchase at a time. And that kind of demand is structural. There's a moment in every market cycle where price and reality disconnect, where the number on the screen and the experience on the ground tell two completely different stories. Silver, in late January and early February of 2026, entered that zone, and most people watching never understood why. The paper market architecture. Here's what they don't teach in basic economics. Silver trades in two worlds. One is physical, metal you can hold, bars and vaults, coins and safes, jewelry and drawers. The other is paper, contracts, futures, derivatives, promises to deliver metal that may or may not exist. And these two worlds don't always agree. On the COMEX, the Chicago Mercantile Exchange, silver futures trade in massive volume, billions of dollars, millions of ounces, leverage stacked on leverage. And when volatility spikes, when prices swing 10, 15, 20% in a single session, the exchange does something predictable. It raises margin requirements. What margin requirements really mean? Margin is the deposit a trader must hold to keep a leveraged position open. Think of it like a safety buffer. When silver is calm, trading in a narrow range, exchanges allow smaller margins. A trader can control a large position with relatively little cash. But when volatility erupts, when silver jumps from 70 to 120 in weeks, then crashes back to 80, exchanges panic, not publicly, not dramatically, but systematically. They increase margin requirements, sometimes by 20%, sometimes by 50%, sometimes more. And when that happens, traders who were comfortably positioned suddenly aren't. They get margin calls. They're forced to either deposit more cash or close their positions. And most don't have more cash, so they sell. Not because the silver story changed, not because demand disappeared, but because the math, the leverage math, stopped working. The forced liquidation cascade. Here's where it gets brutal. When one trader sells, the price drops slightly. When 10 traders sell, the price drops noticeably. When hundreds of traders sell all at once, all forced by the same margin pressure, the price collapses. And here's the part that confuses retail buyers. Physical demand during this collapse doesn't disappear. In fact, it often increases because people watching from the sidelines, people who couldn't afford silver at 120, suddenly see it at 80, and they think, opportunity. So they walk into shops, they place orders, they buy. But the screen price, the COMEX price, keeps falling because the paper market and the physical market are operating on different mechanics. One is driven by leverage and liquidation. The other is driven by availability and accumulation. And the gap between those two forces is where premiums explode, the premium divergence. Imagine this scenario. Silver spot price on a trading terminal, $79. Silver purchase price at a coin dealer, $92. That's a $13 premium. Over 16%. Why? Because the dealer knows something the screen doesn't reflect. The dealer knows how hard it was to source that metal, how long the last shipment took, how uncertain the next delivery is. The dealer knows that while paper contracts are being liquidated by the thousands, physical metal is being bought by the ounce. And in tight markets, physical wins. Always. The industrial demand layer. Here's what makes silver different from gold. Gold is almost entirely monetary. Its value comes from being a store of wealth, a hedge, a reserve asset. Silver is split, half monetary, half industrial. Solar panels, electronics, medical devices, batteries, conductors. Silver gets consumed, used up, turned into products that never return to the market. And that industrial demand creates a floor, even when speculators panic, even when futures markets crater, even when sentiment turns negative. Factories still need silver. Manufacturers still order it. Supply chains still require it. So while gold can sit idle in vaults for decades, silver disappears into the economy. And that difference, that structural consumption, makes silver's volatility both a risk and an opportunity. Two scenarios playing out. simultaneously. Analysts watching this market, the serious ones, have mapped two possible paths. Scenario A, the steady rotation. Retail demand grows, not explosively, but consistently. Premiums rise gradually. Availability tightens slowly. Inventory depletes over months, not days. In this scenario, patient accumulators win. They build positions without panic. They average in during dips. They ignore the noise. Scenario B, the acceleration event. A headline hits. A supply constraint becomes public. A major buyer enters aggressively. Suddenly, everyone wants silver at once. Premiums don't rise gradually. They spike. Availability doesn't tighten slowly. It vanishes. Wait lists form. Delivery times stretch. Panic buying begins. In this scenario, early movers win. Late arrivals pay dearly. And the question every buyer faces is simple. Which scenario are they preparing for? Why volatility punishes the unprepared? Silver doesn't move in straight lines. It whipsaws. It shakes. It tests conviction. A buyer who enters at 80 might watch it drop to 70 within days. A buyer who sells at 70 might watch it climb to 90 within weeks. And the difference between those who survive and those who capitulate isn't knowledge. It's discipline. Because volatility in thin markets is a feature, not a bug. It's how leverage gets flushed, how weak hands exit, how real accumulation happens. And the buyers who understand that don't fear the swings. They expect them. There's a difference between knowing something is happening and knowing what to do about it. Most people stop at the first part. They read the analysis, they nod along, they agree with the logic, and then they do nothing. Not because they don't believe it, but because belief without a framework leads to paralysis. So this section isn't theory, it's execution. The ratio as a strategic reference point 64-1. That's where the gold to silver ratio sits today. But what does that number actually mean for someone trying to make a decision? It means this. If gold and silver both preserve wealth, but silver is trading at a historic discount relative to gold, then silver offers asymmetric positioning, not guaranteed, not risk-free, but asymmetric. Because if the ratio compresses, if it moves from 64 back toward 50 or 40 or 30, silver doesn't just rise with gold, it outperforms. And if the ratio stays stretched or expands further, silver might underperform or stagnate or test patience. The ratio isn't a crystal ball, it's a map. And maps don't tell you where to go, they just show you where you are. The 3-signal system for market temperature. Smart participants don't rely on headlines, they watch behavior. And behavior shows up in 3 specific places. Signal 1, the language people use. When someone walks into a shop and asks, "What's the gold price today?" they're thinking about gold. When they ask, "How much silver can I buy with this amount?" they're thinking about allocation. That shift in phrasing, small as it seems, reveals a mindset change from admiration to participation. Signal 2, how sellers respond. In normal markets, dealers compete for customers. They offer deals, they negotiate, they make it easy to buy. In tight markets, dealers compete for inventory. They say things like, "Let me check availability. Next shipment uncertain. We're limiting quantities per customer." When the conversation changes from "would you like to buy" to "we might not have enough," the market is heating. Signal 3, wait times. If someone can order silver today and receive it tomorrow, supply is normal. If the answer is 2 weeks, supply is tightening. If the answer is "we'll call you when we know," supply is stressed, and stress in physical markets always costs money, either in higher premiums or in missed opportunities. What business owners should understand for entrepreneurs, for business operators, for anyone managing capital, precious metals aren't speculation. They're insurance. Insurance against currency debasement, against banking system fragility, against the risk that paper promises don't hold. But insurance only works if it's in place before the crisis. Not during, not after, before. And the window for calm, rational positioning is never as wide as it feels. The verification discipline. Here's a truth nobody wants to hear. When excitement rises, fraud rises with it. Fake bars, misrepresented purity, counterfeit stamps, shaved weight. Not everywhere, not most dealers. But enough, that verification becomes critical. So for anyone buying physical metal, 3 rules apply. Rule 1, only buy from dealers with verifiable track records. Established businesses, no names, reputation that predates the current cycle. Rule 2, insist on documentation. Receipts, purity certificates, serial numbers, proof of authenticity. Rule 3, test when possible. Wait, dimensions, magnetic response. If buying size, third-party verification isn't optional. Because in hot markets, mistakes are expensive. And trust, without verification, is just hope. The premium acceptance framework. Here's the uncomfortable reality. Physical metal, almost always, trades above spot price. That gap, the premium, covers dealer margins, shipping, handling, storage, insurance, and risk. In calm markets, premiums are tight, 2 to 5% over spot. In hot markets, premiums expand 10, 15, 20% or more. And buyers face a choice. Wait for premiums to compress and risk availability disappearing, or pay the premium now and secure the metal. There's no universally correct answer, but there is a wrong approach, refusing to pay any premium while watching supply evaporate, because the cheapest price on metal you can't acquire is irrelevant. 3 rules for disciplined execution. Smart participants across every market cycle follow the same principles. Rule 1, never buy because of fear of missing out. FOMO-driven purchases happen at tops. They're emotional, they're rushed, they're expensive. Rule 2, never sell because of fear of embarrassment, selling to avoid looking foolish, or because peers are skeptical, or because a position went against you temporarily, is how good strategies get abandoned early. Rule 3, make decisions when calm, not when the chart is vertical, not when the comment section is screaming, not when the headline is alarming, when calm, because calmness is the only state where logic operates. The mainstream threshold. There will come a moment, if this rotation continues, when people who never cared about silver and start asking about it. Colleagues, family members, neighbors. Should I buy some? When that question becomes common, the shift is moved from early to late, not over, but late. And late is when mistakes multiply, because the late crowd doesn't buy metal. They buy emotion. And emotion, in volatile markets, is expensive. The closing framework. This rotation from gold to silver and others is driven by 2 forces, affordability and narrative. Affordability pushes people towards silver. Narrative keeps them there long enough for habits to form. And habits, once established, become structural. The opportunity for those paying attention exists in the gap between pattern recognition and crowd arrival. That gap is narrowing, not gone, but narrowing. And the participants who position now, calmly, methodically, with discipline, won't need to chase later because they'll already be holding what everyone else is starting to seek.